It starts innocently. A busy year, a difficult stretch, a return that slips past its deadline. Most people assume the consequences are trivial. A small fine, perhaps a stern letter. The reality is more layered. Penalties that scale, interest that compounds daily, default assessments built on the ATO's numbers rather than yours, and a quiet elevation of your risk profile. I am Tin-Lok Shea, tax lawyer at Australian Tax Experts. In this presentation, we will walk through exactly what follows a missed lodgement, with the figures updated for the new penalty unit that took effect this month, and, more importantly, the clear path back for anyone with returns outstanding. Whether you are 1 year behind or many, this is fixable.
Four numbers, current as of this financial year. $364, the value of one Commonwealth penalty unit, indexed up from $330 on the 1st of July 2026. Every failure to lodge penalty is built from this figure. $1,820, the maximum FTL penalty for an individual, 5 penalty units, with larger entities paying multiples of that. 75%, the administrative penalty that attaches to a default assessment on top of the estimated tax itself. That is the expensive end of non-lodgement. And around 11%, the general interest charge accruing on unpaid tax, compounding daily, and no longer tax deductible. Individually, manageable numbers. Left to stack for years, a very different story.
First, the deadlines themselves. If you lodge your own return, the standard due date is the 31st of October, following the income year that ended on the 30th of June. Miss that date as a self-lodger and the penalty clock starts. Lodging through a registered tax agent changes the picture considerably. Agent lodgement programs generally extend the due date, typically as far as the 15th of May the following year, one of the quieter benefits of being on an agent's books before the 31st of October. And beyond individuals, every entity has its own calendar. Companies, trusts and partnerships have their own return deadlines, and employers carry separate obligations for BAS and payroll reporting, each with its own penalty exposure. The common thread: know which deadline applies to you, because "I thought I had longer" has never remitted a penalty.
Now the FTL penalty mechanics.
For an individual, the penalty is one penalty unit, $364, for each 28-day period, or part of one, that the return is overdue, capped at 5 units, $1,820 per return. Multiply that across several outstanding years, and the total becomes serious. For businesses, size multiplies everything. Medium entities pay double, large entities 5 times, and significant global entities 500 times the base penalty, a maximum of $910,000 for a single late document. But here is the balancing point. Remission is realistic. The ATO can reduce or cancel FTL penalties where there are acceptable reasons, and a one-off lapse with a clean history, lodged promptly, is often remitted in full. The pattern in the ATO's behavior is consistent. Engagement is rewarded. Silence is not.
Here is the pattern we see in practice, and if it describes you, you are far from alone.
It starts with one missed return: illness, a business crisis, a divorce, a year that got away. Then avoidance sets in. The task feels bigger with every passing month, and a strange logic takes hold. Lodging now feels riskier than staying quiet. So years accumulate. 2 returns outstanding, then 4, then more, each making the next feel harder. And then the ATO moves first. Default assessments, penalties, and enforcement action, all calculated on the ATO's numbers, not yours. The psychology of this cycle is completely understandable. The economics of it are brutal. And the single most important fact about it is this:
The cycle only ever breaks in one of two ways. You act, or the ATO does. The first is always cheaper.
Let us look closer at the destination you want to avoid, the default assessment. Where returns are not lodged, the ATO has the power to simply assess you anyway, estimating your income from bank data, industry benchmarks, and assumptions. Those estimates are built to be safe from the revenue's perspective, which means they are typically very unfavorable to you, often significantly overstating your actual liability. Then comes the penalty. A default assessment attracts an administrative penalty of 75% of the tax-related liability, on top of the estimated tax, with interest running on the lot. And perhaps worst of all, the burden of proof flips. Challenging a default assessment means proving what your taxable income actually was, years later, without the records, from a defensive position. Nobody should ever let a matter reach this point. Lodging late, even very late, is categorically better. While penalties arrive in defined amounts, the interest is quieter and often ends up larger. General interest charge accrues automatically on unpaid tax from the day it was due, currently just under 11% per annum, compounding daily, at a rate reset each quarter. No ATO officer decides to impose it. It simply runs. And since the 1st of July 2025, GIC is no longer tax deductible. The after-tax cost of carrying a tax debt has jumped substantially because the interest can no longer be softened by a deduction. Put simply, delay is the multiplier on every other number in this presentation. A penalty is a fixed cost. The interest is a growing one. Every month of avoidance grows the debt faster than most investments grow savings, which is the most practical argument there is for acting now rather than next quarter. Now for the encouraging part, because the system does have a heart if you know how to reach it. A client came to our office with several years of unlodged returns. The cause was not carelessness. A medical condition had genuinely prevented them from managing their affairs, and while they were unwell, penalties and general interest charges had been quietly stacking up. We prepared and lodged the outstanding returns and built a remission submission around the ATO's own guidelines, evidencing how the client's circumstances had prevented timely lodgement year by year. The result? All penalties and all general interest charges were remitted, in full. The saving was substantial, and the client's affairs were back in order. The lesson? The ATO can show genuine flexibility for genuine circumstances, but only when someone makes the case properly, with evidence rather than apology. One more reason to act that has nothing to do with penalties. What non-lodgement signals? Failure to lodge is one of the ATO's key risk indicators, a flag that selects taxpayers for broader scrutiny, beyond the missing returns themselves. And remember that the ATO is not waiting in ignorance. Employers report your wages, banks report your interest, platforms report your income. The data flows in, whether you lodge or not. The ATO already holds most of the picture. Your return is largely confirming it, which is why silence reads so badly. Years of non-lodgement invite far worse assumptions, concealment, undeclared cash, evasion, than an honest, late return ever would. Lodging late says, "I fell behind." Not lodging at all lets the ATO write its own story about why. So here is the way back, 4 steps that turn a years-old problem into a closed file. First, act before the ATO does. Voluntary lodgement, even years late, consistently produces better penalty outcomes, better remission prospects, and better relationships than anything that starts with an ATO letter. Second, reconstruct the records. ATO pre-filled data, bank statements, and employer reports can rebuild even old years. Missing paperwork is almost never the barrier people fear it is. Third, lodge the lot, in order. A complete catch-up managed as one project presents far better than a trickle of returns that invites questions about what else is outstanding. And fourth, negotiate the penalties and interest. Remission submissions and payment plans put to the ATO with your circumstances properly evidenced. Most catch-ups are cheaper and faster than the person dreading them ever expects. This is work we do every week at Australian Tax Experts, where tax lawyers and accountants operate as one team. We manage catch-up lodgements, multiple years prepared and lodged efficiently, including full reconstruction where the records are long gone. We pursue penalty and GIC remission, your circumstances presented properly against the ATO's guidelines, as in the case where every penalty and every dollar of interest was remitted for a client prevented from lodging by illness. And we handle ATO negotiation, default assessments challenged, payment plans agreed, enforcement headed off before it starts. If you have outstanding returns, the hardest step is the first phone call. Everything after it is easier than you think. If you have outstanding tax returns, contact Australian Tax Experts today. Addressing the issue now, before the ATO acts, will always produce the better outcome. Visit australiantaxexperts.com.au/contact for a confidential conversation. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.